All right, trading officially underway on this Friday. Stocks looking to wrap up what has been a winning week on the back of some solid economic data and a host of IPOs, which we've been covering here at the Stock Exchange. Joining me now to talk more about the markets is Kevin Gordon. He's a senior investment strategist for Charles Schwab. Kevin, thanks so much for joining.
Hey, Kristen, nice to see you in your relatively new seat.
Kevin, I'm going to get my audio fixed though so I can hear you, but we know inflation data this morning certainly coming in a little bit better than expected. What does that mean for investors?
So, I think it continues the story, what has been the story for inflation of disinflation. I think it's a relatively solid and increasingly benign backdrop. Not that, risks don't exist anymore, but what was evident in the data this morning, but what has been evident over the past several months is that you're on a really solid path in terms of getting to the Fed's 2% target. Core PCE out this morning as of August on a 3-month annualized basis is, still at 2%. There was a slight uptick from the prior month, but I think the important part from an inflation standpoint is that when you sort of survey the economy and you look at different parts of where inflation could be coming from, it's kind of tough in from our perch and from virtually any perch, I would say, to see where a lot of inflationary pressure is going to come from. And in particular, if you look at the labor market, you still believe in, sort of the strength of the Phillips curve and whether that relationship exists. There's not a lot of pressure coming from labor anymore. You've got unit labor costs running at 0.3% year over year as of the second quarter. You've got, this continued slowdown in payroll growth and then the drift higher in the unemployment rate. So I think it's been, right for the Fed to shift to focus on labor. But at the same time, you've had a still relatively resilient labor backdrop as inflation has continued to roll over. So, it's not mission accomplished and the Fed hasn't declared victory, which I think is the right move. But I think that the broader story of labor staying resilient with disinflation occurring is still with us and probably will stick with us for the next several months.
Kevin, we're looking at fractional gains here as we look to round out, again, what has been a positive week for stocks. And what I'm hearing from you is it sounds like that soft landing might actually be in store. A big question as to whether or not the central bank could engineer a soft landing, avoiding an economic recession amid its interest rate policy. Does the GDP growth of 3% give you more confidence on that front?
So, I think of soft landing in terms of sort of a process, not as much a destination. I think the destination is actually you either get to an expansion or you get to a recession. So to me, you're sort of living a version of the soft landing right now. And, we've had a more nuanced take about soft landing versus recession. We think that, already some parts of the economy objectively have gone into their own little recessions. But if you were to look at everything in aggregate, yes, it's virtually looked like a soft landing. And I think it's even been supported more so by the fact that when you start to look at some of the revisions that we got for GDP yesterday morning for the past several years, going back, almost 4 years, that to me was the most important story and has been the most important story from a data perspective this week, because not only did you have relatively significant revisions to the upside for GDP, but you had significant upside revisions for gross domestic income. There had been, a huge gap between the two over the past several years, with a lot of economists actually forecasting that GDP would sort of catch down to GDI, but you had the opposite happen. So what that means from a corporate profit perspective, from a labor perspective, from a revenue perspective, is that things have looked relatively healthier, and it actually is consistent with sort of a more resilient labor market picture. So I think all of that data, even though it's a look back and even though it's history now, is supportive of the fact that we've sort of been living in a soft landing environment. So from here, yes, you have to watch the trajectory of labor. You have to keep in mind the tightness in monetary policy and how much that's going to impact the economy. But we're heading into this period, on stronger footing than we previously thought.
And we've seen several IPOs of late. Investor sentiment seems to be improving, of course, a lot of that fueled by the recent action by the Fed just last week. Kevin, do you think that stocks can continue to advance from here?
I think so, but from a valuation perspective, there's probably not as much to be squeezed out of the upside in a PE multiple or a price to sales multiple, because you're trading at pretty rich levels relative to history, regardless of the larger cap index you're looking at. It's a little bit of a different story for small caps, but that's been the story for a while now. I think from a breadth standpoint, you're still in a great spot for the S&P 500. You've got close to 80% of its members trading above their 200-day moving average. You've seen a little bit of a softening and a pullback in the number of companies or the share of companies that are making new highs, but you're not seeing a pickup in the share that are making new lows. So you're kind of, I think, in this, moderate sort of tepid territory where, gains are probably still with us for some time and you've got some underlying strength. But I think it's also the market's way of looking ahead and sort of trying to suss out if there's any labor weakness coming or, what the trajectory of a softening economy actually looks like. So I don't think it's anything sinister, but I think that the breadth picture right now, especially when you compare it to other cycles where the Fed started cutting and started off by cutting by 50 basis points, you're in a much stronger position from an equity market perspective. So I think that's definitely the more positive aspect of the market and what the signal's been sent, the signal that we've sort of gotten over the past couple of months.
Where do you see opportunities in this market?
So, the focus on quality for us has been a big thing, and it may seem sort of like the ultimate duh statement over the past couple of years, but when you look at the factors and the characteristics of the market, at least in the U.S., that have been outperforming and that have been leading consistently since this bull market began, almost a couple of years ago in October of 2022, the sort of consistent leadership across sectors and up and down the cap spectrum has been within high quality parts of the market. So companies and industries that have relatively strong profit margins, that have strong revenue growth, that are able to manage their labor costs well, high interest coverage ratios because of the rapidity with which rates went up. That has been the more sort of consistent area to find leadership, and we think that's probably going to continue to be the case. Even though you've got rates now rolling over, it's not that the Fed is getting accommodative and that policy is getting stimulative. It's just that it's getting less restrictive. So if you're staying sort of in this net restrictive territory, but things are starting to ease sort of at the margin, that probably still benefits high quality parts of the market. I don't think you're going to get this sustained significant outperformance from lower quality sectors or industries or even stocks that would tend to outperform after the Fed cuts aggressively. So I think that's an important distinction to keep in mind, is to stay up in quality in terms of looking for and screening for those characteristics, regardless of the sector that you're in.
Kevin Gordon with Charles Schwab. Kevin, always a pleasure. Thanks so much for your insight, especially as we look to round out yet another winning week here on Wall Street.
Thanks so much.